Hello and good afternoon. Welcome you to today's weekly market outlook for Admiral Markets. My name is Klatt and I will guide you through the upcoming 30-45 minutes around, give you an outlook for the upcoming trading week, which economic events will be important to watch, and which economic events, respectively, price action or moves in general in the markets have been interesting over the last days of trading, and what can we draw for conclusions out of it, especially probably in the DAX. But before we want to start, first of all, we have to have a look here in the risk disclaimer. Please make sure that you understand that trading with financial instruments offered by Admiral Markets, that these financial instruments carry a high level of risk, which is probably not suitable for all investors due to their complex nature. And before entering into a client agreement or making a transaction, please make sure to read the terms and conditions of the service from Admiral Markets. Further information can be found on the website admiralmarkets.com, or also contact Admiral Markets directly. Their customer support will help you out with every question you might have. So then there is, since August 2018, a differentiation between retail clients and professional clients, and here is now some important changes which have to be announced, respectively have to be made a topic here too. There's now a leverage restriction for retail clients with a maximum leverage of 1 to 30 for Forex majors, so like Euro USD, USD JPY, for example. But also 1 to 20 for other currency pairs. This is like minor currency pairs, GBP CAD, for example, just to name one. But 1 to 20, this leverage restriction is also true for CFDs on indices like the DAX. We want to make a topic in a few seconds, but also gold here. And this is now what is the current version for retail clients. There's a differentiation, as already mentioned, for professional clients. So here's a short list of some of these differentiations, or the differences in this case. If you're a retail client, you have a leverage restriction, as already mentioned. If you're a professional client here, you don't have such a leverage restriction and can trade it up with a leverage to 1 to 500 here. Now, one aspect which is already mentioned around the classification of a retail client is that after ESMA there is a 100% negative balance protection, which means you are unlimited protected against negative balances. In case of Admiral Markets, there's something really interesting. They came up with a very interesting solution for professional clients too. There you are protected up to £50,000 sterling according to the policy from Admiral Markets. If you are allowed to recategorize yourself as a professional client or not, which criteria you have to meet for this. Also, therefore, please contact directly Admiral Markets. This is me. My name is Klatt, as I already mentioned. Here is the answer to the question, why Admiral Markets? Here in Germany, where I'm located in this case, we refer to Admiral Markets as the so-called DAX expert, in fact, because of the very, very competitive offering that Admiral Markets offers in the DAX 30 with a typical spread of 0.8 points during the main trading hours. What's also important around Admiral Markets, why Admiral Markets is a great choice as your broker, probably in terms of regulation. So they are regulated by the FCA in England. They are also registered in Estonia and authorized and regulated by the Estonian Financial Supervision Authority. They are registered and regulated by the SISEC, and they're also very interesting regulated here from the Australian Financial Services license, or they hold such a license here, and they can do business also in Australia. So Admiral Markets, one broker, in fact, one world, and the global offering here. Further information, please also reach out to Admiral. There's the contact details, which I mentioned several times now. And after this short introduction around Admiral Markets, let's have a look here at our agenda for today. So we want to answer the following questions in the upcoming minutes then. What are the key economic events in the coming week of trading? We want to answer the question, what's the current bias in the FX, equity and commodity markets? Therefore, we want to use mainly the commitment of traders report and the positioning of large speculators in this context. And then we want to answer the question which trading opportunities may arise. And so with this in mind, click. We are now ready to go over here into the DAX, and this is the daily chart, and you can already spot a black line, and this black line is something we refer to from a technical perspective as so-called bullish divergence. And so such a bullish divergence occurs when the market we are looking at, in this case the DAX 30 CFD here, when this market makes new lows. In this case, in fact, last Tuesday we made, that was the 20th of October, we made new yearly lows, but did not push below 11,000 points. This is, I think, this is noteworthy here in this case. But what's even more interesting is the fact that now we haven't made it here to lower lows in the RSI 14. So lower lows in the chart, but higher lows in the RSI in this oscillator. And this is usually a sign that the momentum on the downside is diminishing, and is a potential sign that probably the DAX in this case is about to form a bottom here, form a bottom here, and is probably about to see a pullback here, and probably will make it then back towards 11,670 to 11,700 points. All in all, it's in fact very, very interesting current market environment currently. The reason for that is because November is usually the second strongest month in the year from a historical perspective in terms of performance. So usually you have the strongest month in the year, which is the March, then we have November, and then the third strongest month in terms of performance is in fact December. The chart for this will be published, by the way, in the traders blog from Admiral Markets on the website on Monday. So everything I present here, you have the chance to follow it in a written form then on the website. I just want to show you where. So this is the economic calendar. We'll have a look at this in a few seconds. So what we want to do is probably, that makes the most sense, go via the website here, admiralmarkets.com. And there you have then several buttons at the top of the page, and there you go to analytics, and there you click on traders block, and here you usually find several articles every week, and one is the weekly market outlook, which has been a while. It's November 19th, so from Monday. Here, there the headline read, "Will the Brexit mess push GBP/USD down to and below 120?" No, it hasn't so far. Let's see what the Brexit summit over the weekend delivers. That's something we'll have a look at then around the FX markets, around the euro and pound sterling. But again, here, so analytics traders block on Monday around, yeah, it should be 11 a.m. German time, I think, when this article is published then on the website there, and there you can read all those comments around the DAX in this case, the bullish divergence, and also those performance numbers for the month to follow it. But let's come back to the price action. So all in all, I have to say that it looks more and more that the DAX probably has a chance at least to make back some of the losses it has seen here over the last weeks, and let's say weeks from October, November. Even though I think we are already in the position to say this will be the first year with losses, so a red year, let's call it, since 2011, last time when the DAX closed in the red. The only question is, will it be a yearly close in a double-digit atmosphere, which means a year loss then from the start of the year of more than 10% or less than that. And so far, I have to say, my personal feeling is that it probably will be less than 10%, which means from the current levels that we'll potentially see a pullback, even though the overall picture stays bearish. As long as we trade below 11,700 points. Probably pessimists will probably say everything below this purple line here. This is a 200 simple moving average will be or should be considered bearish then for the DAX in this case. So yeah, that's it from this end here around the DAX. Another aspect which is interesting is that the DAX is about to enter, not only from a historical and statistical perspective, a quite bullish a period of the year, but I'm sorry. Is it correct? Oh, that's exactly what it was, what I wanted to say. So it's not only price action. I'm sorry, I jumped. It wasn't just only the price action with this bullish divergence, but it's also the fact that we are now about to enter one of the most bullish periods in the year from a statistical standpoint in terms of performance, which is very interesting also when looking at other, in this case, high yield currencies. And therefore, probably it makes sense to first of all not look at Euro USD or GBP USD, but first of all have a look here at the Australian dollar on a daily time frame in this case. Let me just do it that way probably. Does it work? Yeah, I think it's okay. Gets the job done. So what I think is really interesting is from mid-December onwards, the Australian dollar. By the way, 1 second, please. Let me just so that we're on the same page and can see which asset we are looking at here. So Australian dollar USD. We are definitely not in a very bullish market environment, even though after this breakout of this channel, a downward channel here in this case, it's the first positive sign, and there was already a first attack at the region around 73.30 here. We didn't make it above that level. Nevertheless, I have to say, as long as we trade above 71.50 here, we are in a environment where I could imagine the Australian dollar probably to gain some further momentum, and if we make it above 73.30 here, there's further potential up to 74.30, 75.50. And in fact, Australian dollar and the equity markets, in this case the DAX, are very strongly positively correlated to each other here, which means usually when entering this period of the year, it's not only that equities see or are more likely to see gains, but the same is true for the Australian dollar here in this case. And it could be that such a push higher in the DAX in this case goes hand in hand with Australian dollar trading higher than over the next weeks of trading here too. This is true as long as we trade above 71.50. If we drop below that level, I don't want to be long anymore. I'd be really careful with that, and probably wait for a better opportunity. Yeah, so that's it around the Australian dollar. Let's have a look here at Euro USD now. Also very interesting picture, because it hasn't changed that dramatically over the last days of trading. So this week, in fact, is very interesting because we have Thanksgiving, or we had Thanksgiving, and we also have Black Friday. And all in all, volatility stayed low, even though when looking at the DAX, for example, yeah, definitely. I was surprised. Let's put it that way. I was really surprised to see the DAX dropping that aggressively, also on Thanksgiving itself, by the way. So we had a quite aggressive drop on the downside that day. Let me just have a look here in the 5-minute chart. So this is the 5-minute aggregation of the DAX in this case, and we saw some heavy losses here of more than 150 points within minutes after the spot market Xetra opened, and that was really surprising. Nevertheless, and now let's come back to the FX markets. Overall, the picture is nearly the same as the week before, in this case for the euro, respectively for pound sterling. And this has something to do, in case of the euro, not only with the Brexit, but also, sure, with the Brexit, but also with the still tense situation between Brussels and Rome around the Italian budget for 2019. As long as there's no clear sign that there will be a solution found, which does not result in especially some kind of pressure being put on Italy, on especially then also Italian banks. You don't necessarily need to push or put pressure on Italian banks, but it would spill over to these banks and probably result in the risk of probably a bank run. I'm not sure if I would go that far, but let's just put it that way. As long as the situation is as tense as it is currently between Brussels and Rome, there's definitely a mixed feeling when you say, okay, I want to be long the euro. The same is true from a Brexit perspective. Let's see what the Brexit summit then over the weekend delivers. I think I'll be capable of putting some note into the weekly update or the weekly market outlook in written form then, which is published in the Traders blog on Monday. Currently, we can't really say in which direction it will go here. Only thing I heard was that Angela Merkel, the German Chancellor, is pushing the European Union here around this summit to find a solution. After this escalation in the UK Parliament last week, with several resignations followed from the cabinet here from Theresa May after she tried to let's say sell the negotiated Brexit deal to her Parliament in this case. So headwinds were to be expected, but the escalation then there resulted in a no confidence vote, or at least speculations around this. It hasn't been triggered yet, but nevertheless it shows that there's some tensions. And then Donald Tusk came from the European Union and said, well, we don't care if they find a deal or if they agree or not, we'll run the summit if they have a deal or not, which is kind of I put it that way. It's not really the way you expect partners to behave to each other. Let's put it that way. And especially Germany is scared here, and the reason for that is because UK is still a very big trading partner of Germany. So the fourth biggest, in fact, after the US, after China, and after France. And so finding no real deal with the UK here, Brexit deal in this case, will definitely trigger some let's say losses for the UK European not European but German economy, which will spill over to the European economy, and we're not even mentioning the British economy here in this case. So the thing is, I really said the same as I did already last week. I don't really know in which direction especially the summit will go now, so it's purely speculative, and so we have to just wait what this delivers. From a technical perspective, we can say that everything below 115 here in Euro USD stays bearish. So from a technical perspective, you just don't want to be long Euro USD below 115, and that's also something you can then see here in the commitment of traders report. Therefore, we go to the website barchart.com, and then you click here on futures, and there on the commitment of traders report, and then you will guide it to a site where you can find the the commitment of traders report for nearly every market, financials, currencies, and there you have the Euro FX, and there you can click on it, and then you will see that here it's a subdued short positioning of large speculators. This is the green line in this case. So you can see it here. It's minus 37,000 contracts. Those large speculators are currently short the euro. This is a sign that there is these market participants are probably not really sure if they should aggressively bet against the euro here. There's, from a fundamental perspective, currently there's definitely a reason. And this reason can be found in the quite wide yield differential between European and US treasuries. Treasury yields in this case. On the other hand, we also know that there is some willingness from the ECB in this case to be more restrictive in the monetary policy from next year onwards. So from the second half of 2019, we will discuss rate hikes, and the question will be, when will these rate hikes come? If there's some troubles around the Brexit and negative impacts this has on the European economy, surely these rate hikes will be delayed. But those market participants, large speculators, you can see them here, they are unsure in which direction they should bet here. So there is a net short positioning that this is mainly due to, in my opinion, due to the fact that we have a negative yield differential from a euro perspective when looking at European and US yields, even though we have to say, okay, as long as there is signs at least that probably the Fed won't be as restrictive in her monetary policy in 2019 as we expected her to be in the last meeting in September. Now, after all this volatility hit the markets, we have to say this is also something to keep in mind. There's lots of selling pressure to be expected if the situation around Brussels, Rome, respectively around the Brexit escalates, even though there is at least also some skepticism around those large speculators if they really should bet aggressively against the euro here. So yeah, that's it around the euro. Let's have a look here at pound sterling then. So there's the picture. We have to still wait, whether we can hold and stabilize above 26.70 to 27. So you can see here, this push higher could be expected to some extent. I was not very positive about the US dollar after last week's inflation data especially, and so far it seems as if this plays out, even though I have to admit that I still see a potential break lower to 127 or below 126.70, 127 here as an opportunity. And if this really happens, it depends on which driver is which fundamental news will trigger such a break lower, but everything which probably also forces the Bank of England to cut rates again after Brexit, if this is a hard Brexit then with no deal being found, everything is capable of pushing pound sterling aggressively lower, even though the headline was probably a little too early. We remember what I had the headline I just read aloud here for the weekly market outlook a few minutes ago, when I said will we see a push down to 120. So this is still an option, especially if we break below 26.70, 27. Nevertheless, as long as no such escalation around the Brexit, hard Brexit in this case, or the Bank of England really standing up and saying, okay, we have to do whatever it takes to support now the British economy. As long as this does not happen, we won't push down to 120. So that's it around pound sterling and the US dollar. Let's have a look here at gold now. Also very interesting, I think. I didn't draw such a positive picture for the US dollar, which means on the other hand, gold is probably about to see some stronger pushes higher. This is especially true if 10-year yields in the US will push below 3%. In this context, I want to show you here Market Watch, the website, and there you can then see that currently the market stabilizes above 10%. That's definitely true, and you won't see any big moves here into the weekly close due to the Thanksgiving bank holiday, respectively Black Friday. You can see it here. So last data which we saw an update was 7 p.m. Eastern Standard Time. In this case, that was on the 21st of November. So today is the 22nd. So it was yesterday. The bond market is closed, so you don't see any big moves happening here. Nevertheless, what we have to say, what we can clearly spot, is that this is a crucial level. 3% also from a psychological perspective is a very, very important level, and there are chances that we push below that level, especially if volatility stays elevated. So something to keep in mind, even though I drew a quite positive picture for the DAX in this case, which goes hand in hand with a positive outlook for US equity markets too in the upcoming week. Then that doesn't necessarily mean that it will come that way, and it could be that volatility stays high. And if volatility stays high and US Treasury yields here push then below 3% again, which points to a risk off mode, it could be that the Fed probably won't hike in December. Therefore, you can look at the Fed Watch tool. We won't do that here, but the Fed Watch tool shows that still the chances of a rate hike is only 75%, which goes hand in hand with the former Fed dot plot of 12 out of 16 Fed members voting for a rate hike, or back then in September voted for a rate hike. Even if they hike rates, I think when you look at the yields here, which pushed to the highest levels since 2011, there was already also some speculation that the Fed will be quite restrictive in their monetary policy approach in 2019. too, which means there was lots of bets pointing to a rate hike priced in the US dollar already, which resulted in a quite aggressive push higher then. And that said, we have to say with this in mind, even if the Fed hikes rates then in December, it doesn't necessarily mean that they will go for a similar restrictive monetary policy approach in their statement on the 19th of December. It could be that they come out with a very dovish hike, and both not hiking, that would probably be even more a big hit for the US dollar than to be expected. But also, if they hike and it's a very dovish hike, both scenarios are very, very negative for the US dollar. And that goes then hand in hand with a very, very positive outlook for gold in this case and a potential push higher. And also here, something to remember, probably it's a little too early right now, but I assure you that over the next 2 to 3 weeks, we will have also some seasonality patterns, which I want to present here in the weekly markets outlooks, where we will see that gold has a very, very positive outlook for the next weeks to months ahead. So from December, mid of December till the beginning, the first 2 weeks of January, usually you have a very, very positive window here for gold. It's not set in stone, so it could be that gold drops, but nevertheless, look at what happened last year, the year before, 2016, 2017. You will see that gold pushed aggressively higher here, and that was only, in my opinion, driven by seasonality aspects. And so with this picture in mind, seasonality, and then also the potential drop in US yields, potential drop in the US dollar, there's a good chance that gold will see another attempt to break above, in this case, the red line you can see here in this chart. This is the level around 1,244 USD. If we push a lot above that level, there's good potential then, which will easily push us as high as 1,280, 285, probably 295. And this is true, this bullish outlook is true as long as we trade above the green line, which is 1,180 USD. So this is definitely something to keep in mind, and a very positive outlook in general for gold. And yeah, so that's it around gold then. And finally, let's have a look here at dollar JPY. It's still a very neutral picture. If you zoom out of the chart, you can spot, okay, a sequence of higher highs and higher lows. So that's true since the beginning of March. That was around, by the way, when those news hit the wire from Donald Trump around those tariffs which could be implemented. We remember the deficit. Not only China, but also Japan and also Germany is running against the US, European Union, but here especially Germany, is running against the US. So it's no big surprise that we saw this rally here. The only question is if this, is this a sustainable move? I mean, a sustainable move in terms of what should we expect if there's no further rate hikes to be expected. If there's really negotiations between the US and China, especially Japan, but probably most likely, which will affect the global economy, will be the discussions between the US and China. And if they find a solution, you can expect this to spill over then to the JPY or Japanese economy in this case, also the European economy. This could all result in some heavier USD selling, and in this case, then dollar JPY is getting really interesting. So probably not yet. We're still in a very neutral environment, and all in all, next week of trading probably won't see such big moves. Then, nevertheless, there is still some potential. Let's say that if this picture I've drawn here around the US dollar materializes, that this then will push dollar JPY lower, and we'll see another attempt to break below 111.50 here, so that the US dollar probably does not see very, very bullish weeks to come, in fact. Yeah, so that's it on dollar JPY. And by the way, I just forgot, probably one of the most interesting currency pairs here for the next week of trading, and probably not only for the next week of trading, but also for the days now around Thanksgiving and Black Friday, because while many traders around the globe, especially FX traders and US located FX traders, probably will say, okay, I take 2 days off and enjoy a prolonged weekend, Canadian FX traders are probably, or dollar cat traders in this case, are probably saying, well, there's one news event we shouldn't really underestimate then in the next hours, respectively in the next 24 hours here. There's your Canadian inflation data being published. That is on Friday already, and this has not necessarily something to do here. You can see it here. It's Friday the 23rd. That's tomorrow in this case. You will probably say, okay, but does it really affect next week of trading? I think so, yes, especially around here. These data, or the data set which will publish then next Friday on the November 30th, and in this case, GDP growth rate. So there has been speculations around a more restrictive monetary policy approach from the Bank of Canada here after their last meeting. I've also written an article around this, by the way, and the interesting thing about this is now, then shortly after, inflation data was published from the Canadian from the Canadian economy, from Canada, and it came in significantly below expectation, and they came in, by the way, at 2.2% and was expected to come in at 2.8%, and this is noteworthy because in combination with the quite aggressive drop in WTI crude oil prices over the last weeks, or since the beginning of October, the thing is, if the inflation data tomorrow comes in at the same rate, at the same level as it came in last month, 2.2%, it's something to be expected, but it's also taking away to some extent the pressure from the Bank of Canada, and taking away the pressure here in terms of hiking rates rather sooner than later. And so with this in mind, I think that this picture here, we have this sequence of higher highs and higher lows on a 4-hour chart. You can clearly see it here. There's a good chance that we probably see another attempt to push higher, especially if inflation data comes in, by the way, below 2.22 or 2%, 1.9, let's see. But if data comes in really below expectation again, it could result in another attempt to break higher to 133, 133.30. And by the way, if you go now on a daily chart, you can see that this is the region around the current yearly highs. It's slightly higher than that. It's 33.80 around. But if we break above that level, you will see that further gains are probably likely, so which could push Canadian dollar up to 137.80, probably 38 over the next weeks of trading, and probably also before Christmas, somehow depending on if there will be some kind of a relief rally in WTI crude oil or not. If not, I think such a push higher is definitely an option, and to be closely monitored and closely watched here. And it all starts tomorrow, when nearly no one's somehow watching, around the inflation data. So inflation data will be something really interesting, and could level the path for further volatility in the upcoming weeks to come, or in the upcoming week to come then. And that's it from my end. So I hope that you got some valuable information for your trading. I wish you all the best. Happy trading. Watch your stops, and talk to you again then next week, Friday the 13th of November. I definitely look forward to it. If you have any questions, please feel free to shoot them over. Send them to Admiral Markets. They will answer them, or if not, they forward it to me. I will answer them. If you want to talk to me in this case, whatever, just feel free to reach out to Admiral or to me directly. I really look forward to it, and I'd really appreciate it. Have a nice weekend. All the best. Happy trading. Watch your stops. Talk to you again next week. See you, and bye-bye.